The first quarter earnings season kicked into high gear today with a mixed bag of reports from three big banks, JPMorgan, Citi, and Wells Fargo. Here to discuss the earnings and what they tell us about the state of the economy is David Ellison, a portfolio manager at Hennessy Funds. Thank you so much for joining me today, David.
Good to be here.
Well, David, JP Morgan is the clear loser among the three banks reporting today, with its shares down more than 5%. It looks like there was some disappointment over the bank's forecast for full year net interest income, and CEO Jamie Dimon raised several points of concern about global economic developments. What can you tell us about the report?
Well, I think you kind of covered it there. I think you know, the issue here is the stock's been up a lot in the last 6 months, and the numbers have been good the last couple of quarters, a lot driven by the First Republic acquisition that was completed, I think, about a year ago or close to that. And so those benefits are rolling off. But at the end of the day, the stock went up a lot, and now people are selling the news. And the news of the fundamentals they're okay. They're fine, but it's not a surprise to the upside. People were hoping for better numbers and they didn't get it. And so they're selling.
So, how does the changing outlook for the Federal Reserve easing on JP Morgan and the banking business overall?
Well, I think the yield curve's been a problem for a long time now. We're at close to record time for the yield curve to be inverted historically. And that's obviously a problem for the banks. Uh, I think the struggle with the industry is not credit. It's not the Fed. It's really not the regulations that people talk about or the lack of loan growth, all these things. I think the issue is really what are the cost of funds going to look like in the next 3 to 5 years. We've had a series of banks that have had problems primarily because deposits have fled. And that historically has not been a problem for the industry. And now it seems like it is. And so the cost of funds is a real sort of unknown as we go forward here. And I think that's weighing on people's sort of excitement about the group because you just don't know what those cost of funds are going to be and whether they're going to stick around at all.
Mhm. Well, Jamie Dimon, he is worried about financial markets. He described today as too happy. He says he's not predicting a recession. So, what is he talking about? Is it possible that he's too gloomy, maybe?
Well, again, I think as you're a banker, so you got to plan for the worst and hope for the best. I mean, that's what banks do. They're supposed to lend money in good times and lend money in bad times. So you got to be prepared for all outlooks. But I think you've got the economy's been good for a number of years. You've got home prices at all-time highs or close to it. The stock market is just recently at all-time highs. Unemployment is at, pretty much historic lows, at least, if you go back 20 or 30 or 40 years. Government spending is helping a lot of people. So, the tide is pretty high right now. And I think if I'm a banker, I'm saying, okay, well, let's prepare for the tide to go out a little bit, if not a lot, and survive that and go and be through it and be functional through that cycle. And so I think that's what he's really saying. And I would be saying the same thing.
So, before we turn to Citigroup, is there anything else you'd like to add about JP Morgan?
Well, again, it's one of the big three banks that, is diversified. It's obviously making a ton of money in terms of dollars. Um, and I think it's one that, is not doing well today, but is worth staying at if you're going to be in bank stocks.
Well, okay, Citigroup. It also beat predictions and seems to be benefiting from a restructuring. What can you tell us about that?
Well, that really is a show me story. The stock is a lot cheaper than JP Morgan. JP Morgan's at $180, give or take. Citicorp's at $60 today, and they both have the same book value.
Mhm.
So just from a valuation perspective, it's a lot cheaper, and it's deserved that for many years because it has been sort of floundering around trying to figure out what it is, change of managements, and so on. And I think the hope for investors for over the next couple of years is that they find their footing. establish themselves, figure out who they want to be and what they are. And, that's the opportunity here because they're, again, one of the four anointed, FDIC insured banks that won't have a problem if deposits run, the Fed will cover them. And so that's helping them. And I think that's, the story is okay to better. JP Morgan is sort of good to great. And you'd usually make more money when things go from okay to better from a stock perspective.
Really? Why is that?
Well, this is it's a cyclical industry. You need cycles to make money in this group. If things are good all the time, then people gravitate toward growth stocks. And we've seen that in the last, number of years. Everybody wants to own NVIDIA because they grow 30% a month. JPMorgan, Citicorp, Wells Fargo, they're not growing loans. They're not growing deposits. They're really not growing revenues. They go up and, the market is, they've done well this quarter because they have, decent investment banking revenues, but those are episodic and a low PE business. And so people gravitate toward, the growth companies, and that's what's happened. And so you need cycles. You need cycles to make money in this space, and we haven't had cycles. The Fed has taken that away by lowering rates and then raising rates and quantitative easing and quantitative tightening, and the federal government's come in and help people out. So if there's no cycles, then people go to growth. And I think that's the issue with the banking industry. It used to have cycles, and that's when you made your money. 2008, 9, 10 was a great time to buy banks and financials because they went from ugly to okay to good to great. And the stocks reflected that. Now it's sort of good to great all the time. It's
So
like
what
there's
about
not.
Wells Fargo? Would that be ugly to okay, good to great? Where would you put that?
Well, that one's again, it's sort of in between Citicorp and JP Morgan from a valuation perspective. They have had management issues, as we all know about, and I think the look at this quarter was actually pretty good. It was probably, I don't, everybody has their own way of deciding who has the best quarter, but I think they're doing a pretty good job of becoming a better bank and defining themselves for what they used to be. I mean, Wells Fargo used to be the standard years ago, and then management decided to somehow stop paying attention. They lost all that, and they've been in the penalty box for half a decade. And so the hope is that, the new management will finally sort of get themselves out of that, and, people will trust them and understand what they're trying to be and price it accordingly.
Well, Wells Fargo also missed net interest income estimates, but its stock barely moved. How is the situation different from JP Morgan?
Well, again, I think it's valuation. I think it's JP Morgan's at 130, 120 a book. I think Wells Fargo's at 130 a book, and Citicorp's at 80% or 90% a book. So it's a valuation issue. And I think that's the big part of it. And, so there's good and bad in all the reports. But again, these are big banks. They're all competing for the same customers. They all sort of have the same macro impacts. It's hard to grow loans. It's hard to get deposits. They're competing in the investment banking arena. They do some insurance. So, they need macro conditions to really be cyclical for the stocks to be sort of places you can make money over time. And again, if credit deteriorates, it's going to deteriorate for all of them, and vice versa when it gets better. So, because they're all in the same, they're big banks. They're all, going after roughly the same customers, and they're in the same geographies and so on and so forth. So I'm hoping for a cycle. I've been hoping for a cycle for half a decade, and we haven't had it because that's how I make money. If you look at the stocks, they haven't done anything for 10 years. So I'm sitting here making no money, and the CEOs are making a ton of money. So, as I say, there are times to be a CEO and there are times to own the stock. And this is not the last half decade to the last decade has not been a good time to own the stocks because there's been no cycle. And the Fed's, again, I've mentioned that already. There's no cycle, and there's a lot of other alternatives out there where they're growing faster. Again, the technology industry is an industry that has profitability metrics that I don't think the world has ever seen in terms of their ability to generate gross margins, um, and generate, earnings without a lot of assets. They're very asset light. Banks are asset heavy, subject to regulation, subject to the yield curve, subject to what the Fed wants to do, subject to, people's willingness to pay their credit cards and so on and so forth. And they're sensitive to people trying to do IPOs and making money and the competition that goes into that. So it's a low PE business in the good times. So you need the bad times where you can buy them at, half a book or a third a book and trade them back to book value. And that's a good return, but we just haven't had that.
Well, David, is there anything else we should be watching for when other big financial companies report their results next week?
Well, I think the big issue is going to be what's the trend in the deposit costs and the trend in non-interest bearing deposits. That, as I said, all the other sort of metrics don't matter. The story is going to be the next 3 to 5 years is what are those deposit costs going to be, and can they hang on to those low cost deposits that have historically been the bedrock of their profitability. Again, the assets in the business is not the assets, it's the liabilities. And if they start losing those, and if they become more expensive, it will sap long-term profitability and presumably show up in the stocks.
Well, thank you so much for joining me today, David.